Hello guys, and welcome again to one of these videos. This time we will be talking about the candlestick patterns, how to program these in Python. So our code will recognize specific patterns and maybe detect price trend reversals. Then we will be backtesting a strategy using candlestick signals, and with a simple statistical approach we're going to check what are the chances of having a winning automated bot that will rely on candlestick predictions. So if you are interested by the content, you can download the program file from the link in the description below, and I hope you guys will enjoy this one. So this video is not specifically about explaining the candlestick patterns. I would assume you are already aware of those. Just let's go through some of the most known forms of candlesticks. And keep in mind, this list is not exhaustive, so there are many more models out there. We will just stick with the basics for now. You may already know the doji showing an undecided trend. Then we have the shooting star, what is called the shooting star. You don't have to have two next to each others. You can have either the first form or the second form. The most important thing is to have this long tail going above the body of the candlestick. And when you see this, for example, and you have an uptrend, it might be an indicator that you might have a trend reversal in this case. So you might expect that after this kind of candlesticks, you will be switching to a downtrend. Then we have the hammer. The hammer is very similar to the shooting stars, although it's inverted somehow. So this one shows if you have an uptrend, you have some kind of rejection at this point, long low tail. In this case, you might have a trend reversal, and it might indicate that your uptrend is coming to an end, and you will have a downtrend retracement at this point. Then we go to the bullish engulfing pattern. This is when you have a downtrend and your last candlestick is the red one here, but then it's completely covered with a bigger upward candlestick, the green one. That might be announcing the end of the downtrend and the beginning of a following uptrend. Then we have the bearish engulfing pattern, and this happens when you have completely the opposite of what we've seen here with the bullish engulfing pattern. You have an upward trend, then you have two candlesticks, one that is an upward candlestick. This is the last candlestick of the uptrend. Then it is covered by a bigger candlestick announcing the end of the uptrend and probably the beginning of a downtrend. As I've already said, we have other candlestick patterns that we're not going through all of them right here. So you have, for example, the three crows and so on. But in this video, I'm specifically interested in the shooting star, or the hammer if you take a downward trend reversing into an upward trend. Why? Because simply this is one of my favorite patterns. It clearly shows a reaction of the market to an uptrend. I mean, you could clearly see that the sellers stepped in the market and rejecting a certain price level. This is why I tend to trust this pattern more than the others. Although you might not agree with me, of course, it depends how you are using these and what are you combining these patterns with. I mean, you can be using different indicators or sticking only with candlesticks. It depends on the strategy you are using and on many different parameters. However, in my case here, in our case for this video, let's take this one as a good example of price rejection and the reaction of the sellers that is so strong that would give this candlestick its form, what you can see here, and this long tail that we are calling here the shooting star. And specifically, we are interested in how to code this pattern in Python, how to let our bot recognize such patterns. Of course, you can always extend what we are going to see in this video to different patterns that are more of interest for you. And then we are going also to backtest the strategy that we will be building relying on the shooting star to check whether this can be a winning indicator or it's just a random as many other promising indicators. So let's go ahead and see if it's worth it. Naturally, when you see this candlestick pattern, we should be looking for a sell signal. You have the open price at this level, then you have the closing price at this level, but in the meantime, during the timing of this candlestick, you have a very high level, and very close low level. The low and close values are very, very similar here. And to code this in Python, we can do the following. The high value minus the open value divided by the body. The body is the open minus the close values. This is the body length of the candlestick. So I want that the high minus the open, this distance, divided by the body length should be higher than a certain ratio. Should it be twice as high, 3 times as high, 4 times as high? I don't even know for the moment. I'm going to test those in the code. But in order to have this shape recognized by my code, the first rule is to have this comparison with the ratio respected. Then at the same time, I don't want to have this lower tail here to be too big. So to restrict this, I'm going to do the close value minus the low value divided by the high minus the open should be at least, let's say, half or maybe 1/4 of this long tail. So this tail here divided by the long high tail should be equal to 0.5, 0.25, something that the user or you will be tuning or optimizing according to the market. So just keep in mind that we have those two ratios here, ratio 1 and ratio 2. This was for the sell signal. For buy signal, we could apply exactly the same approach, only taking symmetrical values. I'll not go through all the details now. However, using candlesticks on their own is not really enough to have an accurate sell or buy signals. So they should be combined with your favorite indicator. In this case, we will be combining these signals with the RSI, with some values of the RSI, the relative strength indicator. You might prefer to take these into account along with a different technical indicator or even a fundamental analysis maybe. Just candlesticks on their own are not sufficient. Now for backtesting winning rate of our prediction approach, we must combine it with a strategy. First, we identify a buying signal. We'll talk about the technical details later on, but at this point, we know that we need a stop loss value. So for a buying signal, it will be the price value minus the average true range. And this is a common use of the ATR. In case you are not familiar with it, the ATR is a really good way to decide where your stop loss will be. So it's not too close in a way that it will be triggered very often, nor is it too far, which would lead to big losses in case it's triggered by the price value. Simply because when you have a very volatile market, your ATR will be large enough to increase your stop loss gap. And if you don't have a volatility, you will have a very small ATR. And in this case, your stop loss will be relatively close to your price. Then the take profit is equal to the price plus a certain ratio, which I will be calling take profit stop loss ratio times the ATR. And for this example in this video, we will take the take profit stop loss ratio equal to 2. That means the take profit is twice as far as the stop loss. This way, every winning trade will make up for 2 losing trades. Let's consider, for example, that I have a buy signal at some point, and then I will be calculating the stop loss value according to this formula here. It's the price minus the ATR. And then the take profit is twice as far from my buy signal than the stop loss. So it will be at this level here. This is my take profit. Then I'm gonna let my program run forward for these candlesticks and check if the price will be touching the stop loss first. In this case, I will have a losing trade. And if it touches the take profit value first, I will have a winning trade. And since we took the take profit stop loss ratio equal to 2, this means that theoretically each winning trade will make up for 2 losses. And in this case, we need to be right 34% of the times to have a winning system. And we are saying theoretically because here we didn't count for the cost of the trade, the fees of your broker, and the overnight swap values. Let's keep it simple for now and try to see how we can code all of this in Python. Okay, so let's start by loading our data file. I took as an example the US dollar Japanese yen values, the daily candlesticks, because I believe that it's easier to do analysis on daily candlesticks. You have less noise, less fluctuations, less uncertainties than in smaller time frames. The data that I have is between these two dates, the 5th of May 2003 and 19th of October 2019. And it's a CSV comma separated values file. So I will use the read_CSV function from the pandas module here. And I will store all of this in a data frame, into a pandas data frame that I'm going to call df. And to make sure that everything was read properly, I will simply print the df tail or the head of my data frame. So here we have 4,327 rows. And then I will test if any candlesticks have volumes equal 0, because these are days where you had something wrong. It's either something wrong with the data itself. So these I'm gonna get rid of. And as you can see, we don't have any candlesticks with 0 volume. Next, since I'm going to use a strategy where I will need the ATR values and the RSI values, I have to include those into my data frame. So I'm gonna use the pandas_TA technical analysis module. It's as easy as this. I will call the column ATR, the values returned by the function ATR from the technical analysis module, taking into account the last 10 days, since we are using the daily candlesticks. For the RSI, I will also add it using the RSI function. By default, the last 14 days. And I'm gonna drop all the non-valid, so my data is properly cleaned. Then we will define a function that takes a data frame and provides back a signal, if it's a buying signal or a selling signal, according to the candlestick patterns. In this function, we will test for one single pattern, which is the shooting star or the hammer, if you want to check the buy signals. So at this stage, we have to reset our index, because when you drop the NA rows, the index will not be a consecutive numbers anymore. So we have to do a reset. Then I'm gonna store the length of my data frame into a variable. The high list will be containing the high column values, then the low column values from the data frame stored in the low list, the closed list, and the open list for the open values. Then I will be defining 0 values lists of the same length of the data frame, one for the signal for each candlestick, one for the high difference, the low difference, the body difference, and the 2 ratios that we have explained in the algorithm previously. Now we are ready to start our analysis in this function. For each row in the data frame, the high difference is equal to the highest value minus the maximum value between the open and the close of the price. So this is the length of the high tail. If you recap from what we have just explained, if you want, you can look to this form here. This is the length of this high tail here above the body of the candlestick. The body difference is simply the length or the height of this body. It's the absolute value between the open price minus the close price. And since this value is going to affect my calculation later on, I don't want it to have a 0 value. If just in case I have open price that is equal to the close price, then I will have a body difference of 0. In this case, if the body difference is less than 0.002, which is a magic number, I simply chose this randomly like this, we will give it a body difference value of 0.002. So in other words, it cannot go below this value. Then the low difference value is the minimum between the open and the close price minus the lowest value of the candlestick. And this is the length of the small tail that you can see here down below the body of the candlestick. Then we define our first ratio. Ratio number 1 is the high difference, the long tail length, divided by the body difference, the length of the body. And the ratio number 2, ratio 2, is equal to the low difference divided by the body difference. Okay, at this stage, we can start looking for our sell signal, which is the shooting star in our case. And I'm gonna start by testing if the ratio 1 is higher than 2.5, which means that the length of the tail here up divided by the length of the body of the candlestick is strictly higher than 2.5. And at the same time, I want that the low tail here below will be shorter than the third of the high tail as a maximum length. So I'm going to say that the low difference is less than 0.3 times the high difference. Now, where am I coming up with these values 0.3 and 2.5? These are parameters that you can optimize on your own. There is no rule to decide on these. However, it makes sense to choose ratio 1 above 2 just to have this shooting star form, and to have a low tail, it can be 0.2 or 0.3. You have to test which one will give you the better results. At the same time, I don't want to have a very small body of the candlestick. I want to limit the body difference to higher than 0.03. These conditions here will be defining my shooting star candlestick pattern. But at the same time, as we've said, it's not enough on its own. So I can use also the RSI, the relative strength indicator, and I want my RSI to be higher than 50% and lower than 70%. The reason I'm using these values is that below 50% might be an indicator that we have an oversold currency. However, if you have something higher than 70%, it might also indicate a strong upward trend. And I don't want to enter the market with a sell position when you have such very high values of the RSI. So I think the optimal values for selling between 50% and 70%. So if all these conditions are true, my signal at this particular row will be equal to 1. So this is our first category, which is the sell category. At the same time, we can do the same method to detect buying signals, while obviously the candlestick will have a symmetrical form. You have a longer tail and a very short high tail. And of course, this is also combined with the RSI values. I'm taking an RSI that is less than 55%, but also higher than 30%. So as you can see, it's not very much symmetrical. You have some small differences between buying and selling. And this is very interesting to keep in mind that the market is not symmetrical. You cannot use the same conditions for a selling bot and also for a buying bot or a buying signal. I prefer to optimize buying and selling signals in a completely independent way. And at this stage, our function is finished, so we should simply return the signal value. Then I can add these signals to my data frame by calling the function. If I want to count how many selling signals I got in my data frame, I could simply execute this command here. And as you can see, we have 36 selling signals at this stage. So just remember, these are 36 signals within 15 years. So it's not much. It gives you approximately 2 trades per year. However, you don't have to stick with one single currency. You can apply the same program or the same bot on 10 different currencies, and this will lead to around 20 signals per year. Okay, so now we can move on and test our strategy. I will define a new function called myTarget. It takes 2 parameters, the bars up front and a name of a data frame. Starting from a certain position or from a certain candlestick, this function will look to a number of bars up front, let's say 16 bars ahead or 18 or 20 bars ahead, and it will check if the price will be touching the stop loss first or the take profit first. And in this case, I would be defining if I have a winning trade or a losing trade. The stop loss is given here. The gap between the price and the stop loss is provided by this pip difference here. And as you can see, I'm using the ATR, the average true range value. I'm not multiplying it by anything. It's multiplied by 1 at this stage. Of course, so my trade will be valid. There must be a certain minimum for the stop loss. It cannot be too close to the price. So here we are setting this minimum to 1.1 for the Japanese yen US dollar trading. And the stop loss take profit ratio is set to 2. And this will define the gap between the price and the take profit value. Then the function does what it's meant to do. It will be going and testing all the bars up front and see if the price will be touching the stop loss first or the take profit first. And if the price doesn't touch any of these 2 values, we have a third category which is equal to 0. It's a trend category 0, which means that we have no clear trend for a certain candlestick or a certain bar. And basically that's it. This is what this function does, and it would return the value as a result. And I'm going to show you the data frame at this stage. Okay, we have the open, high, low, close prices. We have the volume column, the ATR, the RSI. These are only non-valid numbers just at the beginning, because remember, we need at least 14 or 10 values to have the first real value, depending on which parameters you are using. Then we have the signal. The signal is equal to 1 if we have a shooting star, and it's equal to 2 if it's the inverted shooting star, the one that is signaling a buying trend reversal. Then we have the trend column for each row, for each candlestick. And now let's just try and check the tail of our data frame. Basically, what I want to test here is the number of times that I had a signal equal to 1, which means a sell signal. And indeed, the real trend was also equal to 1. So the percentage of the times my signaling was correct. Also for the buy signals, I would like to test the number of times I predicted I would have trend equal to 2, which means a buying signal, and the number of times this signaling was correct, meaning that the trend value for the same row was also equal to 2. And to do this, I'm going to set some conditions, a list of conditions. If the trend is equal to 1 and the signal is at the same time equal to 1, or if the trend is equal to and also the signal is equal to, then I'm going to have two values. In this case, I will store these values in the results section, the results column, a new column that I will be adding to my data frame. And now I will test the precision of each category signaling on its own. So I will be printing the number of the times we had a true positive sell signal divided by the total number of sell signals. And for the values that we took above, we have a 61% precision. Remember that anything above 34% is a winner in this case, because we took a stop loss take profit ratio equal to 2. Now, in order to complete the analysis, I can also plot or print the false positives, meaning when did my signal give me a false signal. And this is what we are doing here. I'm printing all the false positives. Let's take, for example, this candlestick here, the number 580. Let's go down and plot our candlesticks between the 550 and 650. And I'm going to check the number 580. Okay, so if I'm looking correctly here, this one is the 580. So as you can see, it is in fact a shooting star. So my program is working correctly. However, the trend behind it went a bit up, and it seems that it touched my stop loss value before going down, and then the price went up again. So it seems that I'm touching the stop loss values before touching the take profit value in this case. So this is a false signal of the candlestick. Although remember that we are also taking into account the RSI. So both these signals were not enough to prevent my model from giving me a false positive in this case. We can go ahead and check another one. For example, the number 760, candlestick 760. In this case, I will plot candlestick 700 until, let's say, 800. And I will go and check the 760. Okay, so it's this one. It's a very nice shooting star. If you can see it on the screen here, it has a very long tail versus the body of the candlestick, the open minus the close values, or the absolute value of these. And then I'm going up. The price is going up, and then it seems that it's touching the stop loss value before touching the take profit, although the price is going down. So this was not really a false signal. It was a true signal. However, the volatility of the market here made it that we touched the stop loss value just before going into our correctly predicted trend. So as you can see, the model is working correctly. I would assume it's correct in 60% of the times, which is something really nice. However, you always need this assistance of a human being. And that is the difference between an automated trading bot where you don't interfere at all. All the trades are done automatically by your program, and the algorithmic trading. With algorithmic trading, it's like what we are doing here. It's a custom-made indicator that would give you selling or buying signals, and then you need a human intervention to take the decision whether this trade should be taken or not. And in this case, if you would see this signal and you get a notification from your program that you have a sell signal, you would naturally put your stop loss above this value here. So in this case, I would say that realistically, this is a winning trade. Now we could at the same time check our buying signals. In this case, we have 92 buying signals within 15 years. So it's 3 times more than the sell signals with the parameters that we took into account. I'm going to change this to 2 here. And as you can see, we are around 42%. So it's not doing as well as the sell signals. However, it's still above 34%. So theoretically, you are still a winner using this system. And of course, we can proceed just like for the selling signals. We can check the false positives. For example, I'm going to take this one, the 439 candlestick, 439. So let's go down and check between the 400 and let's say 480. I'm gonna plot these and I'm gonna check the 439. Okay, so it's this one here. This is the 439. As you can see, there is a long tail, and indeed it has the shape of buying signal, and it looks like the RSI didn't prevent it either. However, after this false signal, we had a downtrend, and we obviously touched the stop loss before going up to the take profit value. So as you can see, it's not perfect. However, you will not find a perfect system in general. That was it for this video. I hope you guys liked it. You can take the Jupyter notebook and modify these parameters and tune these parameters on your own. Maybe you'd like to use different values here, and maybe you can apply those to different currencies or different maybe stock markets or so. Just let me know in the comments below how it goes. If you want to modify anything or you have specific questions on this topic, do not hesitate. And don't forget to like and subscribe if you appreciated this content. See you next time, and happy trading.